This video is talking about credit unions. So, what exactly is a credit union? A credit union is very similar to a bank. One of the main differences between a regular bank that you might be more familiar with and a credit union is that credit unions are not for profit. Banks, the main purpose of a bank is to make money. The main purpose for a credit union is not that. That's what not for profit means. But other than that really big difference, credit unions provide basically the same sort of customer banking services that a for profit bank does. Let's look at some of the things that are similar between credit unions and banks. Some of the things that they both do. Both of them are financial institutions. Institutions just mean like a sort of like a company. Financial means that they deal with money. So both of them are sort of companies that deal with money. Some of the things that they offer that are the same, they both offer checking accounts and savings accounts. They both offer credit cards. You can buy CDs from both of them. Both of them have ATMs where you can withdraw money from a machine. Both of them make loans. And these are just some of the types of loans that they both offer. They offer loans to businesses, to people to buy property, car loans, student loans. And right here is basically the types of things that most people think of when they think of what a bank does. And these credit unions do as well. Let's look at some of the differences between banks and credit unions. So, like we already said before, banks are for profit and credit unions are not for profit. Um, in a bank, your interactions with bank is you go in there and you open up an account or you take a loan and you are a customer for the bank. Credit unions, when you deposit money in, you actually are becoming a member uh, of the credit union, but you're also considered partially an owner. So in the US, not for profits are there to uh, help the community, and this is the way they do it. They say the people who deposit money and take loans from there, they're members, and the credit union's job is sort of to help those members be financially successful. Because a bank's job is to make money for their owners, and a bank's owners are their shareholders, they treat you as a customer and they try to get as much money out of you as they can. Uh, versus in a credit union, their owners are actually the people who have deposited money at that particular bank or at that particular credit union. And so, therefore, their job is to help their members, which means most of the services that a credit union offers will be cheaper for their owners, for their members, compared to the same services that a bank offers to their customers. So if you take a loan from a credit union, most of the time the interest rate they charge you will be lower. If they charge you fees for an overdraft or for your account, those fees tend to be less. So overall, working with a credit union, you tend to be uh, be charged less financially. Banks have something called FDIC insurance on any money that you have with the bank. Credit unions have something similar. The money there is also insured, but it's insured by a different organization, the NCUA. Banks tend to be a lot larger than credit unions. So credit unions tend to be in just one small location or in a few small locations, while banks tend to be in a lot more locations. So therefore, usually banks have more ATMs available than credit unions do. Um, the bank's ATMs tend to be for that specific bank if you want to use it for free. So if you have, say, Bank of America and you want to withdraw money at ATM for free, usually you have to go to a Bank of America credit ATM. Many credit unions are uh, they know that this is a weakness of theirs, and what they did is they sort of banded together. And so many credit unions, you can withdraw money from any credit union's uh, ATM, and you can do so for free without being charged a fee. Many credit unions basically have done this where they got together. That being said, banks usually still have more ATMs available for their customers. Banks accept all customers, while credit unions, to become a member and therefore open up an account, you usually have to meet some sort of criteria. And common criteria are um, you might have a credit union that forms around an employer. For example, Harvard employees have a credit union. Harvard themselves started a credit union for their employees. So, uh, if you wanted to join the uh, Harvard uh, the Harvard Worker Credit Union, you have to actually be employed by Harvard. Um, for many credit unions, if you have a family member that is part of that credit union, you can also open an account. There are some credit unions that only operate in certain geographies, usually like a city or a state. And then some credit unions are formed around a specific group, maybe a veterans group or a group promoting uh, some agenda. And if you are part of that group, then you can also join that credit union. In the last uh, few years, uh, this has started loosening a lot more, and they've started making the criteria a lot broader. So uh, this might not be as true now as it was, say, 20 years ago. Okay, some other things that are different between banks and credit unions. Uh, because banks tend to be bigger, they offer more different products and services. So while a bank might have 15, 20 different types of credit cards that they might offer, a credit union might only have 1 to 5. Because banks tend to be bigger, they can usually afford to invest more in technology. Credit unions are smaller, so their technology might be a step under. But that being said, most credit unions have a lot of the same technology facing the customer. You can do online banking, you can pay your bills online, all those things. Uh, because credit unions are not for profit, they actually do not pay income taxes. So this is another way that they're able to save money and then pass it along to their members as lower interest rates on loans or higher interest rates on their savings accounts and checking accounts. Banks, like I said before, banks have more locations, and banks can actually be located in multiple states, while credit unions tend to have fewer locations. I had uh, there are people who specifically choose certain banks because that bank will be located in more than one state, and that person happens to travel. So let's say, for example, if you happen to be someone who spends half your time up here in New England and half your time down in Florida, you might want to choose, say, a bank that operates in both those places. So that is one of the advantages that banks do have over credit unions. Because banks tend to be bigger and they're serving a lot more customers, they also can usually have longer customer service hours. While a credit union might only have customer service hours, say from 8 a.m. to 5 p.m., there are many banks who have customer service 24 hours a day. So these are the differences and similarities between banks and credit unions. Banks' main strength is that they are big, and because they're big, they're able to offer many services, uh, many locations where you can withdraw money at an ATM, many stores you can get to. While credit unions' main advantage is that they're a not for profit. So they are not trying to get every little last dollar from the people who do business with them. Instead, they take that extra profit that would normally go to shareholders in a bank and they turn around and use it to save their members money.